Two ETFs can look almost identical on your investing app, but choosing the wrong one could cost you thousands over the next 10 to 20 years. Even when they track the same market and hold the same companies, one could have you paying more in fees and taxes or investing in companies you already own. So before you buy your next ETFs, here are the 4 critical things you need to check to make sure you are actually choosing the right one. Number 1 is the true exposure and overlap check. Now, a very common beginner mistake is buying an all-world or global ETFs and assuming their money is evenly spread across Europe, Asia, America, and the developing countries. It might sound diversified, but it's actually an illusion. In reality, major global indices like the MSCI World put roughly 70% of all their money into the US alone. So when you buy a global ETFs, you are mostly investing in the US economy and big US tech companies. So if the US enters a recession, faces a major political crisis, or passes a law that crushes big tech stocks, your diversified global fund will go down with it. Now, there is nothing wrong with investing in the US, but you should know this so you aren't surprised when things like this happen. Now, if you want a specific exposure to Europe, you can consider investing in an index like the Stocks Europe 600. If you want to invest in the UK market, you can consider investing in FTSE 100. And if you want to invest in developing markets, you can invest in MSCI emerging markets. Now, this brings us to the problem of hidden overlap. Many beginners buy 3 or 4 different ETFs thinking they are diversifying. For example, you might buy S&P 500 ETF, a world ETF, and US tech ETF like Nasdaq tracker. On paper, you hold 3 separate funds, but in reality, you actually hold the same giant tech companies like Apple, Microsoft, Nvidia, Google, and Amazon 3 times over. Now, because of how these ETFs are built, an S&P 500 ETF already puts about 45% of its weight into the big tech, and a world ETF puts about 36% into those exact same companies. Now, adding a tech ETF on top means you aren't spreading your risk. You are piling all your money into one place. And if tech stocks drop 30%, your entire account drops with it. Now, before buying another fund, you can use free tools like the JustETF overlap tool to check the top holdings. Now, if 2 funds share half of the same companies, you are actually doubling down on the same large companies while paying more management fees. And for most beginners, one broad world ETF is usually enough if you want your money to spread across many sectors. Number 2 is the dividend and tax check. Now, when you look at international UCITS ETFs, you will often see 2 distinct versions of the exact same fund. One will have ACK or accumulating in the name, and the other will have Dist or distributing in the name. Now, here is the difference. A distributing ETF takes the dividend cash paid by the companies and sends it straight into your broker account as cash payouts, usually every 3 or 6 months. You can then decide to reinvest it or transfer it to your local bank account. Now, in many countries, anytime you get paid from the distributing ETFs, that payout is counted as taxable income. Your local tax authority might charge you about 15 to 30% in dividend tax right away before you ever get a chance to reinvest that money. On the other hand, an accumulating ETF takes those dividends and automatically uses them to buy more shares for you inside the fund, meaning your dividends are reinvested automatically without you needing to do anything. This is one of the biggest tax advantage investors outside the US have. Now, whether you choose ACK or Dist, neither is a bad choice. You just need to know which one fits your situation and what you want to achieve. Now, for example, if you are working and trying to grow your long-term wealth, accumulating ETFs are usually much better for tax reasons. It lets your money grow and compound over time without triggering an immediate dividend tax bill along the way. However, if you're already retired or you need that cash payout to cover your monthly living expenses, then distributing ETFs might be the better choice for you. Now, while we are on dividends, a very critical thing to watch out for is the dividend yield trap. Now, most beginners get tempted by special high yield dividend ETFs promising about 8 to 10% dividend payout every year. But high payouts can often hide big risk. A company might show a high dividend yield simply because its stock price has crashed or because it's using up cash reserves instead of growing the business. Now, take for example, if an ETF pays a 9% dividend but the fund's overall price loses 15% of its value every single year, you are losing money overall. Only focus on the total growth and quality investment rather than chasing big dividend payouts. Now, if you are finding this video helpful and you are not subscribed to my channel yet, please take a second and subscribe to this channel for free and insightful videos like this. Also like this video so that YouTube can recommend to more people who might need these insights. Now, number 3 is fee and currency check. Now, small fees might not seem like a big deal today, but over 20 or 30 years, they can quietly eat away tens of thousands from your returns. So the first thing to check in this step is the TAR, or total expense ratio. This is the yearly management fee taken automatically from your fund. For index funds tracking major markets like the S&P 500 or the MSCI World, a good rule of thumb is to target a TAR of 0.20% or lower. Now, an ETF charging 0.07% versus one charging 0.50% makes a massive difference over time. For example, investing 100,000 euros at a 0.07% TAR means you are charged just 70 euros per year in management fees. Now, investing that same 100,000 euros at a 0.50% TAR means you are charged 500 euros per year. Now, that's a difference of 430 euros every single year. And the interesting part is that if that portfolio is held over 25 years, that small fee gap and the loss compounding can save you more than 25,000 euros. Now, the second thing to check in this step is fund size, also known as assets under management. Now, a good target is to pick ETFs that have at least 100 million in total fund size, because smaller funds run the risk of being liquidated or shut down by the provider. Now, while you won't lose your capital if a fund closes down, you will be paid out in cash, which can trigger an unexpected capital gains tax event in your home country, instantly ruining your long-term compounding strategy. Now, the third thing in this step is managing your currency exposure on 2 separate levels, which are trading currency and currency hedging. Now, for trading currency, you might want to buy an ETF that trades in your home account currency. For example, in euros, if your account is in Eurozone, or British pounds if you are in the UK. If your broker account is in euros, but you buy an ETF trading in US dollars or British pounds, your broker will charge you a currency conversion fee of 0.25% to 1.5% every single time you buy or sell. So picking the local currency version avoids those extra charges completely. Now, for currency hedging, where you buy a global ETF, the companies inside operate in different currencies like the US dollars or Japanese yen. Now, a hedged ETF uses FX forward contracts to neutralize foreign exchange swings against your home currency, while unhedged ETFs leaves you exposed to natural currency fluctuations. Now, currency hedging is not free. Fund managers usually charge extra to maintain those protection contracts, meaning hedged ETFs typically carry a high management fee, which is often about 0.10% to 0.15% more per year than the unhedged ones. Now, when do you actually use them? A scenario where you might want a hedged ETF is when investing in global bonds or fixed income, or if you have a short-term horizon, because exchange rates can swing widely based on interest rate, inflation, and politics. However, if you are investing for the long-term period like 10, 20, or 30 years, unhedged funds are usually better because over several decades, currency movements historically balance themselves out, and the impact on a global diversified stock portfolio is close to zero. And you also avoid paying those high yearly hedging fees. Now, the next one is safety and structure check. Now, when you search for investing advice online, everyone talks about the popular US ETF symbols like VOO, VTI, or QQQ. But if you are outside the US, like in the UK, Europe, or other regions, and you type those symbols into your broker app, they are either completely missing or says you can't buy them. Now, this happens because of the consumer protection rules called UCITS, which requires any fund sold in those regions to publish a short safety document in local languages called KID, or Key Information Document. Now, since US-based funds don't publish this document, brokers outside the US aren't allowed to sell them directly to you. Now, the good news is that these UCITS rules usually protect you. They make sure the fund is safe, transparent, and well managed. For example, UCITS rules say that no single company can make up more than 10% of the whole fund, which stops one falling company from taking down your entire portfolio. Now, to find the international UCITS version of these funds, look for the word UCITS in the ETF name. However, some brokers don't include UCITS in the title when you search for them. So you will have to check its ID code called an ISIN, which you can easily find inside the key document. UCITS funds are mostly always registered in Ireland or Luxembourg. So their ISIN code usually starts with IE or LU. Now, for example, instead of VOO, which is the US S&P 500, you might want to look for VUAA or SXR8, S&P 500 UCITS ETFs. And instead of VTI, which is the US total market, you can look for VWCE or FWRA, which is the all-wide UCITS ETFs. And also, you will want to check whether the ETF is passively managed or actively managed. Now, actively managed means the ETF is run by professional portfolio managers who try to predict which stocks will win tomorrow, and they charge you extra for it. And the performance of the fund depends heavily on the manager's personal skills and strategies. Now, a passively managed ETF, on the other hand, simply tracks a market list or index like the S&P 500 or the MSCI World. Now, here is where the whole things get interesting. Over a single year, about 79% of actively managed funds underperform the S&P 500. And if you look further over 15 years horizon, about 90% of actively managed funds underperform the S&P 500. Now, how do you know if a fund is actively or passively managed? You can always use a free website like JustETF.com, where it clearly states whether the fund is actively or passively managed. So make sure you always check how the ETF you want to buy is managed. Now, these 4 critical checks I just showed you can all be accessed through the key of the fund you want to buy. And you can also find them from the free website JustETF.com. So save the video so you can easily use it as a reference anytime you are looking for ETFs to buy. And if you find this helpful, hit the like button, share the video with a friend who is starting out, and subscribe for more insightful videos like this. And if you are planning to invest and you are confused on what to invest in, I made a video just for you and it's showing right here on the screen on what to invest in first as a beginner.